This week's number, 5,475 miles. That's the distance between London and Costa Rica, where my team is bonding on the beach. I allowed them to take my plane and said, if you guys work really hard someday, I'll buy an even bigger fat fucking plane. Welcome to Prof G Markets. Today we're discussing NVIDIA's $1 trillion valuation, pairs trading, and earning estimates. Here with the news is Prof G Media analyst Eduardo Elson, direct from Rica de Costa. That's right, Ed. Are you? I trust you're bringing home a mail order bride. What's going on in Costa Rica?
So we got here last night at around 6, and we were doing some work, and then we sat down for dinner at 8. And immediately as we sit down for dinner, giant thundering rainstorm just starts descending down on us. So I think it's a sign from the gods that they want us to keep working.
But that happens a lot down there, right? It's very jungly, right? First off, where are you staying? I don't even know where you guys are. I just know you have my credit card.
We're in a place called Tamarindo at Cala Luna.
Wow. And what's the hotel like?
It's awesome. It's awesome.
Yeah.
We have 4 suites and 1 room. So guess who got the room? But I'm currently in Claire's suite right now.
And what are the activities planned for the team in Costa Rica?
We're going to go, what are we doing, Claire? We're going surfing tomorrow, I think, or maybe on Saturday. We're going snorkeling. They have ATV rides, which I'm pretty excited for. And then we're going to be partying at night. It's going to be good.
So you can go ATV riding. The rest of the team cannot because it's very dangerous.
Is that right?
Yeah, ATV, actually, it's one of my first. So true story, I started a brand strategy firm in my second year of business school. And I pitched, Yamaha Motors came to the High School of Business and said, we want to do a student project. We want someone to help us understand the youth market for motorcycles for Yamaha. And so I said to my soon-to-be business partner, like, this is our opportunity. Let's write them a proposal and try and launch our business. And, I'm first semester, second year at the High School of Business. And so I wrote a proposal saying, look, you need to be serious about this. I'm going to go out and survey 2,000 teens. I just took a market research course, which makes me an expert in market research. And we'll come back and after surveying youth, we'll come up with some insights and product recommendations around youth motorcycles. And I pitched them, and I didn't know what to charge, so I called a friend of mine who had been recruited by and hired by McKinsey, and I said, what would McKinsey charge for this? And he said, we charge $500,000. So I said, okay, I'm not McKinsey. What should I charge? So I put $250,000. I said, all right. And I didn't hear back from them, and I started getting, and my partner was like, what the fuck are you thinking? We're second-year MBAs, and you're trying to charge it from $250,000. We're not. You have no background in consulting. I have no background in any of this. And then I remember I had an apartment in Rockridge, Oakland, and I was paying $280 a month, and went to the mailbox. This was back when I actually looked at mail, opened it, and there was a check from Yamaha Motors for $100,000 and a voicemail from Matt Takazawa saying, sorry, we've been really busy. We didn't get back to you. We're really excited about this project. You should have already received the first payment. And I remember when I saw the check and I looked at it and realized what had happened, I got physically scared that I had just done something illegal. And that was the beginning. That was the launch of Profit Brand Strategy, which then became Profit, which I then sold to Dentsu and is now I think a 500 or 600 person firm.
Yeah.
And there's a lesson in all of this is that the key to starting a business is starting. Yeah. And just committing to doing good work. And they were very happy with us. They used us several times. But our first engagement was with Yamaha Motors. Anyways, I'll bring this back to ATVs. ATVs are really dangerous. They don't look dangerous. They're very dangerous. So you and no one else can go ATVing in Costa Rica. Anyways, talk to us about the markets, Ed.
Let's start with our review of market vitals. The S&P 500 finished May down a fraction of a percent, while the tech-heavy NASDAQ was up nearly 6%. Bitcoin was down 3% on the month, and the yield on 10-year treasuries closed out the month marginally up. Shifting to the headlines. The Wall Street Journal reported that executives and early investors in SPACs made $22 billion by selling shares before they plummeted. SPACs, also known as blank check companies, they are shell firms that are created to take another company public, have lost more than $100 billion in value so far, and at least 12 have gone bankrupt. Job openings in April surged above 10 million. That's the highest in 3 months. And the unemployment rate rose to 3.7% in May. That's up from 3.4% the month before, but it's still near historic lows. Elon Musk has officially reclaimed the title as world's richest person from LVMH CEO Bernard Arnault. That's thanks to an increase in Tesla stock and a decline in LVMH. And finally, Washington passed the debt ceiling bill, which will suspend the borrowing limit and rein in government spending until 2025. Notably, the deal slashes the IRS's budget by around $21 billion. Scott, what are your thoughts?
So the SPAC thing is super interesting and not surprising. It's shocking but not surprising. So it's illegal to sell stock if you think it's overvalued, if you have insider information. But selling your company stock because you don't believe your own hype, there's actually nothing wrong with that. Or I shouldn't say that. There's nothing illegal with that. I guess the question is, in an environment where there's very little fact-checking and platforms where you can aggregate a large followership and you can promote or pump a stock and play off of this FOMO of every retail investor's desire to play in the tech sector, should there be some sort of regulation where if you have a huge following on Twitter and you're saying that a company is not a space exploration company with no revenues or space tourism, it's a software company, and you go on CNBC and you have a huge Twitter following and you sort of weaponize or use those platforms to promote a stock and you own over a certain amount, should you be subject to similar lockups as when you're on the board or some such? Because you can't punish people for having the wisdom to sell when a stock is high, and investors at the end of the day are investors because they want to invest and then ultimately they want to sell. The question is, at some point, is it more than just reputational risks they're taking? Are they taking risks with other people's capital, retail investors' capital? And when they're on wherever they are, whether it's Richard Branson saying, this will inspire new generations. I mean, essentially, Virgin Galactic was a vessel to transfer wealth from retail investors that were excited about the prospects of the commercialization of space to his failing cruise and airlines. And basically, give me money, I'm going to sell stock as fast as I can, and then I'm going to prop up my old earthbound companies. And there's nothing illegal about that. The question is, at some point, if you own over a certain amount and you go online and start promoting a stock, should there be some sort of regulation that basically makes you an insider? Mm-hmm. What are your thoughts?
Well, this is just triggering a thought, which is, I wonder if SPACs should even be allowed to exist. I mean, I remember when one of my friends, who was one of the first members of Goldman's SPAC group, was explaining to me what a SPAC actually is. And he says, yes, you raise a bunch of money for a company that doesn't exist yet. It's just a group of people who have some credibility and have a general thesis and a general vision. And then they go and acquire the company. And then at that point, you can choose whether you want to stay in or get out. But the point being, it just seems pretty insane to me, the idea that we have a vehicle where you can raise public funds for ideas and companies that don't exist, that we don't. I mean, blank check company, the name itself seems ridiculous. I remember thinking that at the time, but then just sort of putting my hands up and saying, okay, well, I'm sure they know what they're doing. But now we're looking at this whole situation. I mean, Goldman SPAC Group itself shut down. And I'm wondering if you think, or if other people think, that SPACs should even be a thing.
Well, it's really not that much different than what a private equity fund does that raises money before they've bought a company.
But not from raising from public funds, from retail investors.
Yeah, well, I mean, there's two ways to look at this. Retail investors want access. They don't want to feel as if they're being held out and only the quote-unquote those rich white people get to play in tech and get to invest early. So to a certain extent, there's a fulcrum between, or a tension between, infantilizing investors and protecting them. And so that's where you find, how do you thread that needle? Because as my colleague at NYU says, and the best regulation is life lessons. And SPACs were essentially a form of investment banking. They've been around a long time, but it was essentially a group of people who said, I'll be an investment banker and take companies public that the investment banks don't want to take public. But I have some personal experience here. I got up right to the goal line, or right to the starting gates, I should say. I was going to do a SPAC. Goldman and Jefferies were going to lead it. I had two friends who both ran separate credit hedge funds, very smart guys, very well respected. I brought in a couple operators to join the operating group, and we were going to do a SPAC, raise $300 million. And it was, I forget when it was, but it was sort of in the kind of seventh inning of all this. And we got on our final call. It was going to cost $3 million in legal fees and banking fees to get public. And then you have essentially, I think, 6 months to identify a target. And then I think, maybe 12 months to identify a target and another 6 months to close or something like that. So you kind of have a gun to your head. The best position to be in is to be a good private company in 2021 and 22, because every SPAC in the world was looking for targets.
Yeah.
And when you knew someone, and when you knew the person on the other end of the line had a gun to their head to try and put this capital to work, you were in a great position. So what ended up happening is a lot of these SPACs were in a terrible negotiating position because there were more SPACs looking to de-SPAC than there were good private companies. And they overpaid. And what they ended up doing was finding companies that, rather than having a strong underlying business, had great badge or curb appeal. See above, Virgin Galactic, right? It's a global brand. Everyone knows it. Or something to do with the internet, or an electric truck company, something that was about the brave new world that they could, quite frankly, that was easy to promote, a very promotable idea, if you will, that was right at the epicenter of technology. And what killed it for us, and we just absolutely dodged a bullet, was I asked my two partners in the last call, it was like, okay, press go, we're about to do this and raise $300 million. I said, how many calls from operating groups have you received in the last 30 days looking to de-SPAC? Because I had received 2 calls that week about a company I'm on the board of saying, we should de-SPAC you, or join us, we'll acquire you, and then we'll de-SPAC. And they had each received 3 or 4 calls in the last 30 days. So I'm like, let me get this. 10 different SPACs looking to de-SPAC, just 3 of us. Do we really want to be on the other side of this trade right now? Do we want to be one of these people calling everyone we know? And our thought was we were going to try and find a consumer company in Europe. We thought that hadn't been as picked over. But within like 90 days, the bloom off the SPAC rose really began to falter. And these things just started diving. And I think the best case scenario was what happened. We didn't do it, but a close second would have been just returning the capital to investors and losing our $3 million. So you do take some capital risk. The worst thing would have been if we talked ourselves into buying like a company that's worth $200 or $300 million, but we would have paid $500 or $600 million. Because what you do is you put your equity into it, but then you go borrow a pipe, additional debt financing to staple on to get the acquisition done.
Yeah.
And then the SPAC, the shareholders in the SPAC get to vote and decide if they want their money back or not, or if they want it to go into the new company. So it's...
And who can blame you if you end up, you're trying to get your money back. What's the best way that you can do that in a short period of time? Go and talk about it on as many media platforms as possible. I feel like you would have been totally incentivized to start pushing whatever you...
Pumping it.
Whatever you...
100%. And here's the issue. For $2 to $3 million, you get, I think, 20% of the company.
Yeah.
So say it's a company that goes out at a valuation of $500 million and you own 5% of it. Why wouldn't you just go on CNBC and use your Twitter following to try and get people excited about it, get it to $1 billion, and then hit the sell button, and in exchange for $1 million, you've just made $50 million. Yeah. Now the problem is, or what we agreed to do, because we saw ourselves as credible investors, is we agreed to a 2-year lockup because we wanted to send a signal to potential investors in the SPAC that we weren't looking to do this. Because even then, we said, it's obvious there's a lot of carnival barkers just buying shit here and pumping it up. But I doubt we would have found a target, because we can all of us are in the, kind of are fairly dangerous when it comes to valuation, and I just don't think we would have been able, given the market, to find something we'd be comfortable holding on to holding on to for 2 years. In terms of job openings, it's good news, bad news. It's great that the job market is strong. We're at historically low unemployment. It's bad news for inflation. And there's a bunch of things that work here. And that is because of anti-immigration laws, we've lost about 2 million immigrant workers. So there's just fewer people to staff a lot of positions. We've also had 2 million, I think it's 2 to 3 million people retire early. And that is post-COVID. They think, you know what, I've had it. They saw their stocks go up. They have some money, some retirement money, and they're like, I'm just not going back to work. And we also lost 1 million Americans. So the labor force has shrunk. A lot of women were taken out of the workforce because they shoulder most of the burden at home, and those burdens were, dramatically increased, mostly because of remote schooling. What's interesting around that, just as a side note, is that female participation in the workforce has not only returned to where it was, it's now at an all-time high. But we've had a decline in the number of able-bodied workers, and also supposedly 3 to 4 million young men have basically just exited the workforce. They're just so discouraged, they're no longer even looking, which begs the question, how are they surviving? So the problem in the United States, we've always talked about there's not enough jobs. That's not at all. That's not the problem moving forward. The problem moving forward is that there aren't enough able-bodied Americans to work. Even the Armed Services says that something like 3 or 4 out of 5 recruits are not emotionally or physically prepared or capable or qualified to be in the armed services. So we're either going to have to dramatically open the gates in terms of immigration or upskill people. I'm a big fan of vocational training, but we have an absolute shortage of workers. I think there's 1.8 open jobs for every person looking for a job.
Mm-hmm. And then let's talk about the debt ceiling bill too. What are your initial reactions to that?
We predicted that the deal was already done, and that strategically Biden, who is a pragmatist, and Speaker McCarthy, who cannot afford to have this go sideways. If it goes sideways, he's out. He'll be one of the shortest serving speakers in history, if not the shortest serving speaker. So I believe they got together a few weeks ago and said, all right, how do we get this done? And Biden said, I'm not going to negotiate with terrorists. And McCarthy said, look, I've got to throw my weirdo some red meat. Give me something symbolic that I can claim as a victory that is meaningless. And we'll take this right up to the 11th hour, and then we'll get it done such that I can claim victory. You don't really have to give up much, and we can get back to we can act, at least pretend to be responsible fiduciaries for the American public. And it looks like that is exactly playing out. They took it to the 11th hour, and President Biden has given some gives that are mostly symbolic, that are almost meaningless, taking IRS budget increases down from $80 billion to $60 billion, which is, meaningful at the IRS, but in the context of a $5.5 trillion U.S. government budget, it's not a lot.
Yeah.
Restarting
just
student
to
loan.
clarify on the IRS, it's not going down to $60 billion this year. It'll only go down $1.5 billion this year, and then $20 billion will be over the next 2 years allocated away from the IRS to other government programs. So all in all, you're taking out $20 billion over 3 years. They're kind of reducing it by around 9% each year.
That sounds right. I think the other thing is that they're talking about a work requirement for certain recipients of food stamps. But if you actually read the agreement, it's actually broadening the eligibility for food stamps. They're forcing the holders of student loan debt to begin repayments. We've had a 2 or 3 year pause. In the context of a $25 trillion economy with $32 trillion in debt and a government budget of whatever that is, $5.5 trillion, this is exactly what we said. It's symbolic and meaningless. Yep. This really isn't a lot. So it looks like that this is going to go through. And at the end of the day, it just speaks to the fact that we're so dysfunctional, we can't even manage basic household finance. The other interesting thing here in terms of jobs is just, I think demographically we're going to find that we're just going to struggle to find people to do work, especially people who want to do work outside of their house. And it's going to raise prices. The stickiest part of inflation has been wage pressure. You could argue that's a good thing because the people who occupy or that fill some of those roles tend to be younger, and we need absolutely to increase the wages of young people and even hopefully attract and draw some more people into the workforce. But I think all roads kind of lead to the same place, and that is we need immigration reform. We don't like to talk about it, but for the last 50 years, we had the most flexible, agile, capable workforce in the world called illegal immigrants. Mm-hmm. And we all winked and nodded at each other as they came in, picked our crops, bathed grandpa, and then when the agricultural season subsided, they went back home. They paid into Social Security without taking out of it because they don't stick around long enough to be Social Security recipients. They tend to be more compliant with the law.
Yeah, I just want to return quickly to the IRS budget cuts. As you mentioned, overall, this debt ceiling deal is almost meaningless. I mean, the overall budget is just not going to increase. They put a limit of a 1% increase over the next couple of years. That's not very meaningful. The meaningful budget cuts are in the IRS. And the thing that I find ridiculous is that the IRS is the one agency responsible for generating more government revenue. And that's the whole problem that we're trying to solve here. We're trying to reduce spending. We're trying to fix the deficit. But part of doing that also means increasing government revenue, which the IRS is responsible for. And we've talked about this before. I mean, a couple of years ago, we were celebrating that Biden was going to invest $80 billion into building up the IRS, into increasing audit rates, which have fallen 93% over the past 60 years, so that wealthy people and corporations start actually paying their fair share. And instead, the Republicans and Democrats have agreed upon, actually, we'll just cut back the one thing that's going to make us money in the long term. Am I alone in feeling like this doesn't make any sense?
It's insane. I mean, first off, you got to give it to the Republicans. They managed to get 47 or 48% of the popular vote by representing the top 1%. And the wealthy have weaponized, and corporations have absolutely weaponized the tax code and government. They make the tax code exceptionally complex. They go from 400 pages to 4,000, all sorts of loopholes, all sorts of tax credits, which means the following. If you're the IRS, it costs X to audit a middle income, a middle class household. I mean, your taxes are pretty simple. You'll put down what you make. It's all on one line. There's the federal and state. You won't even itemize, or you do standard deduction. Boom. If you start writing off half your rent or try to, a red flag will go up. It'll take a case officer an hour or 2 hours. Boom. You'll have to pay penalties. Super easy to audit you. If somebody wants to audit FedEx, or if somebody wants to audit, George Soros, you need a team of a dozen people for 6 months. And so every dollar you cut in funding to the IRS, the government needs 23% of GDP to operate. They have to get it from somewhere. So if they're not going to get it from wealthy people because they're too expensive to audit and they just don't have the resources, they've got to raise taxes on the lower and middle. They've got to raise taxes on everybody else. So any cut in budget at this point of the IRS is nothing but a transfer of wealth from lower and middle and upper middle class income households to the rich and to corporations who the IRS can no longer afford to audit because of the complexity of their taxes at the hands of a tax code that is purposely complex such that I can weave and bob. When you know how to navigate by starlight, you want to run your boat races at night. And that's what the wealthy and corporations and Republicans have figured out a way to do. This is nothing but a transfer, again, of wealth from the poor to the wealthy and corporations.
Okay, let's move on to our first story. Last week, chipmaker NVIDIA hit a market cap of $1 trillion. NVIDIA is the 9th company in history to reach that milestone, and there are only 5 other companies worldwide worth more than $1 trillion. Those are Apple, Microsoft, Google, Amazon, and Saudi Aramco. NVIDIA's stock explosion is a result of the AI boom. NVIDIA is the premier designer of graphics processing units, or GPUs, which are essential for building and training AI models. Sales rose 19% last quarter, and the company's revenue forecast for the current quarter was roughly 50% higher than analyst estimates. So, Scott, clearly NVIDIA is riding the AI wave, but there are a lot of other companies that should probably be riding it too. I mean, AMD makes chips, so does Intel, so does Qualcomm, which have historically been NVIDIA's biggest competitors. But as it stands, NVIDIA's market cap is roughly 6 to 7 times larger than theirs. What about NVIDIA is making it such a winner?
Yeah, it's a correct question. I mean, it really is getting to sort of the executive washroom where there's only 6 other executives. And if you think about market valuation, it's really 2 things. It's performance and promise, and probably not in that order. It's probably more important to have promise and performance. And we got to give it to them in terms of performance. They have essentially never missed their earnings, and that is they've only missed their revenue projection 7 times out of the last 75 quarters. They either meet or beat all of their expectations. So the street and analysts just say this company just continues to deliver. It's also better to be lucky than good. They, started running. They make graphic processing units or chips, if you will, to generate on-screen graphics, and it turned out that the exact type of processor to do this, or the type of chip, fits really well to the needs for generative AI. And now Intel is playing catch-up and also designing GPUs. And in some, NVIDIA was just able to see around the corner better than the other folks. However, there is some good news for all of them. The domestic chip manufacturing and incentives from the Federal CHIPS Act should be tailwinds for Intel, which is looking to expand its factories. And there are rumors that NVIDIA will use Intel to help build some of its chips to decrease its reliance on TSMC's factories in Taiwan and Samsung's in South Korea and China. It's just, this company is, it's just incredible. It's up 163% year to date. I think it's responsible for something like 10 or 15% of the S&P's gain. They have a ton of momentum, especially around AI, which will increase demand for specialist chips by 10 to 15 billion. And as a result, NVIDIA's annual data center revenue, which accounts for 56% of its sales, could double. This is just crazy. The question is, what does this mean in terms of valuation? There's just no doubt this company is incredibly well positioned. With a market cap of $952 billion, it's worth as much as, get this, Intel, AMD, Qualcomm, and TSMC combined. And it's trading at an enterprise value to EBITDA of 145 versus 18 at Meta or 22 at Apple or 17 at Google. The question is this company overvalued? Or is it an amazing company, really well positioned? And I think the answer is yes. I think relative to valuation, I wouldn't get near this thing.
Yeah, and we should talk about the CEO as well, this guy Jensen Huang, who I had never heard of until a couple of weeks ago. Just some interesting character traits. He always wears a leather jacket in every public appearance. Mia found this stat, which is that there are only 2 photos on the Reuters photo database that show him not wearing the leather jacket. He has an NVIDIA tattoo on his arm. He's got this massive Reddit following. The NVIDIA subreddit page has over 1 million members. The thing that I'm thinking when you talk about, is it overvalued? Is it hype? Are we kind of witnessing the birth of the next storyteller CEO, sort of the next Elon Musk?
Well, again, this goes back to instinct. And our instinct is that we need a super being. Our brain is big enough to ask very complicated questions, but not big enough to answer them. So into that void slips a super being. When societies become more educated, the reliance on a super being and church attendance goes down, but we still need those super beings. So the Jesus Christ of an information age is no doubt Steve Jobs. Technology is the closest thing we have to spirituality and mysticism. No one has any fucking idea how their iPhone works, so it feels magical and godlike. And these individuals are also billionaires, which means that it's like sex appeal on top of godliness. And that's the reason why Elon Musk can say these terrible things and act so recklessly, and everybody decides that it's genius, not just a mendacious behavior. So you have kind of Steve Jobs, and maybe Elon Musk is competing for the Jesus Christ of our information age economy. And then you have sort of the 12 apostles, and they all sort of maintain certain traits. One, they leverage a new medium. If you want to outperform your competition, whether you're a CEO or a company, you need to leverage a new medium. And Elon Musk did this with Twitter. Steve Jobs was a master at leveraging and endearing himself to famous tech reporters. Burberry was great at Instagram. Kennedy was great at television. And Mr. Huang has clearly picked Reddit. In addition, Visual metaphors are really impactful. Steve Jobs had a unique look. Michael Jordan has a unique look. Madonna, a unique look. Don King, the boxing promoter, had a unique look. These visual metaphors are really important. And whether it's a black turtleneck or a leather jacket, the personification of a company, trying to personify it such that you like it, such that you will take the multiple on EBITDA up, such that you can raise capital more cheaply, such that you can then invest more in IP and chip design than your competitors, which creates an upward spiral. All of these individuals, think of all of the CEOs of these companies, they're iconic. They have very strong personalities. They have very strong public images. They're manicured by hundreds and hundreds of people. They manage their brands very tightly, and this individual is doing exactly that, and it's paying off.
Yeah, I was going to ask if you think, you just have more experience interacting with these people. Would you say that something like that leather jacket decision is just what he likes, or do you think he's got a whole PR team saying, hey, we liked the leather jacket last week, you should keep it on for the duration of the next decade?
The answer is yes. I'm sure he showed up with it. He likes it. He bought it himself. And then some people on Reddit or some people in the press noticed it. And his PR people said, wear the jacket. We want to be known for it.
Yeah.
And so I'm sure much or most of it is organic, and then they run with it. And you can bet that whenever he gets off a plane somewhere, and there'll be a lot of photographers, one of his PR and comms people are like, I don't want to figure out really hard work. Just put on the fucking jacket. And so that is, very few investor relations and comms attracts more and more capital, and this stuff's important. Imagery is really important, and how you manage visual identity and the words they use in their earnings calls. There's no doubt. It's kind of the new marketing, Ed. There's now, I think at some point there's going to be more people in PR and comms at these companies than there will be at marketing, because the traditional vehicles or channels for marketing, broadcast advertising, are going away. I just read this crazy stat that now less than half of U.S. households have cable television, but everybody reads the newspaper. Everyone has an insatiable appetite for big tech. I could call CNN, CNBC, Canadian Broadcast Company, PBS, and say, I have some insight into Monsanto, and I want to come on and talk about it. And maybe one of the five would say, sure, come on. If I called and said, I have insight into NVIDIA and AI, the 4 out of the 5 would say, can you be on tonight?
AI expert.
It's just the public's obsession with technology and the storytelling around technology is insatiable. If you're watching CNBC, you're really watching tech TV. Occasionally they talk about some of the other stocks, but they really just want to talk about Apple, Amazon, and the Seven Dwarfs.
And then just a final point, we were talking about vertical integration. So something you mentioned, Intel's strategy, which used to be a juggernaut, it's down 45% in the past 5 years. Their strategy was, okay, we're going to design and we're going to manufacture their chips. It's very different to NVIDIA, which outsourced manufacturing to TSMC and Samsung. NVIDIA focused exclusively on design. And now here we are, and their GPU is 39 times faster than their previous one. It's the premier GPU in all of AI training. Do you think that NVIDIA is clearly making the case that businesses should strive to be specialists versus generalists. Do you think that applies to all business, and where does it not?
This is a tough one, because I've been preaching for a long time that you can't get above $1 trillion without vertical integration.
Yeah.
And then eventually Apple Ford integrated into stores. Because in order to get above $1 trillion, you have to have such an incredibly strong culture and brand. You need to control the entire consumer experience. And if you think about the companies that get usually above 200 or 300 billion, they're totally vertically integrated. Verticalization is kind of the trend over the last 30 or 40 years. These guys have bucked the trend, and they've been focused more on design. Now, what they have done is they've sort of taken the Uber and Airbnb model and said, we're going to leverage other people's massive multi-billion-dollar investment in chip-making plants. Chip plants cost billions. And I think what they may have correctly assessed was that there's a lot of manufacturing capacity. What's lacking is truly differentiated chip design around a very specialized IP as it relates to graphics that ends up being really relevant to generative AI. And they just hit it. They just hit the bullseye here, and they probably have better margins because they don't have this 5 or 7 year lag or wait time trying to build a multi-billion-dollar chip plant. Now, the question is, does that make them vulnerable at some point when they don't control the manufacturing? And if manufacturing capacity slows, are they stuck out in the cold? I think that's the question around whether this company can get much further beyond $1 trillion without controlling its manufacturing.
Yeah. Okay, let's move on to our second story. NVIDIA's meteoric rise is indicative of another structural trend. Investors are betting that the biggest companies will get even bigger. So far this year, the 10 largest market cap companies in the S&P 500 have gained roughly 45%. Without them, the entire S&P 500 index would be in the red. Instead, it's up 10%. Now, this applies not just to tech, but to banking, healthcare, energy, and a whole host of others. In fact, in every US industry except for telecommunications, the top 10 stocks have outpaced the rest. Now, the thesis that many believe is that this is a flight to safety. Investors are scrambling to buy shares in companies with large balance sheets and strong margins that can withstand economic volatility and technological change. In other words, they're de-risking. Now, Scott, when we discussed this, particularly in relation to NVIDIA, you mentioned that you're taking up a new strategy called pairs trading. Could you explain to us what that means and what your thesis actually is?
Well, so first off, I just want to say, I want to lay down the context that unless you have the capital to wildly diversify and you sort of do this for a living, and I would argue I sort of do this for a living, the best investment strategy is low-cost ETFs, diversified, Vanguard, and just invest regularly, force yourself, any sort of tax-advantaged, IRA, Roth, any sort of employee match, max all of that out, put it in low-cost funds, diversified funds, and then just ignore it. And when you're 65, you'll be able to retire. I can't help it. I invest in stocks. I do invest a lot in funds. I'm hugely diversified. But an interesting strategy, if you want to take out market risk, is pairs trading. And what that is the following. I can't get a grip on this market. It feels, on the one hand, it just feels historically expensive to me in terms of a price-earnings multiple, given some of the clouds on the horizon and the insecurity in the world. At the same time, I can see something like generative AI unleashing this incredible tech age with all sorts of productivity, and I could see the market just catching fire. You could tell me the market was off 20% in the next year or up 20%, and I would say, well, of course it is, and give you reasons why for each. So a market neutral strategy is to pick 2 or 3 stocks to go long on and then pick 2 or 3 to go short on. And the reason why you do that is I don't want to take a market bet. I want to bet on companies. Technically, this is what hedge funds are supposed to do. The typical hedge fund is 60% long, 40% short, and then they ramp it up with leverage, but we won't talk about that here because they have a bias towards a long position because the natural trajectory of the markets over time is up. The markets do go up over the medium and long term, but they take out a lot of market risk. That way, if the market gets absolutely hammered, they're still okay because they're short on 40% of their stocks. And keep in mind, market dynamics will always trump individual performance. So you can be amazing, but if we go into a depression, you're getting laid off. You can pick a great company that performs, but if the market gets cut by 30%, you're going to wake up and find that that amazing company's stock is down. So this is a means of taking out some of that risk if you're confident that you have some insight into which companies you think are undervalued or overvalued. And I'm thinking about doing it because I want some exposure to the equity markets. I do think there are some companies that have gotten carried away in the hype cycle of AI. I do think there are some other companies that have been caught on the wrong side of the AI hype cycle, see above Google. And this is a means of exiting from market risk, but still being exposed to some trends and some dynamics in the equity markets.
And then finally, just returning to the original stats we were talking about, the S&P would be down if it weren't for the top 10 biggest companies. I think last year we had this feeling that big tech was kind of fading out. I think you used the term, or someone used the term, biggest tech, referring only to Apple because Apple felt like the big winner. But now you look at the performance of all of these companies. I mean, year to date, Microsoft's up 37%, Google 39%, Amazon 42%, Meta's up 118%. Have we officially returned to the big tech era? And if we have, how should investors respond to that?
Well, I think what's happened is every time there's a massive innovation or kind of the next thing, the next big thing, if you will, that usually the value creation accretes to traditional players or to new players. So e-commerce benefited the new guy, Amazon. The phone went to existing players. I think you'd argue that metaverse didn't really go to anyone. The crypto surge went to new players. It looks as if generative AI, if you think it's the next big thing, and it looks as if it is going to go to existing players. I mean, OpenAI has a $30 billion market cap, or valuation, I should say, in the private markets. But I would imagine that Microsoft has increased probably a couple $100 billion since they made that initial investment.
Yep.
And everyone's kind of waiting on it. Amazon, it's the big guys. It's the ones with processing power that can actually service new AI companies and also can put on the front end applications that will be really dominant. For example, Microsoft just released or incorporated sort of a text-based or an AI, generative AI for writers that is essentially a Notion AI killer.
Yeah.
And bundling and capital are really, really powerful. So we have kind of the existing players swelling in value, and now I think 25% of the S&P is just 4 or 5 companies. And the thing about a pair trade, just going back to that,
yep,
is it plays on a couple other things. One, the reversion to the mean. Everyone says that compound interest is one of the most powerful forces in the universe. I've always thought reversion to the mean is really powerful, and that is when a stock becomes just crazily overvalued in terms of PE, eventually it kind of finds its footing again. And the same when it's too low. I mean, just sitting here 8 months ago, not even 8 months ago, 7 months ago, Ed, Meta was trading at a PE of like 9. I mean, it was trading as if it was Ford Motor and had no growth prospects. And it was sitting on top of a massive cash volcano. And what do you know? It's back to where most big tech plays. So reversion to the mean and collapsing that with a market neutral strategy, again, are sort of the attraction here. But we're seeing a crowding again to the big guys. And Tim Wu, professor at the Law School of Columbia, says that the biggest threat from AI is that we're again concentrating more power in the hands of fewer and fewer people.
Yeah. Okay, for our third segment, we're taking a listener question. This is from Muffin. That's not the real name. That's the username on YouTube. Muffin says, can you please do an in-depth explanation about Wall Street expected earnings? For example, are expected earnings made up from a collected average of different predictions, or is it just one entity that formulates predictions? You want to take that, Scott?
Sure. That's a good question, and I'll give you what is hopefully a mediocre answer. An earnings estimate is the consensus of analyst estimates for a company's future quarterly or its annual earnings per share, often referred to as EPS, and then they also will talk about revenues. Analysts use these projections to evaluate the value of a company because most companies in a sector trade within a certain band of price to earnings, and that is the value of the stock over the earnings. So if it has earnings of $10 and the stock's at 150, we have a PE of 15. In certain sectors, companies will trade between, say, 13 and 17 based on the growth outlook or how charming and how cool the leather jacket is of the CEO. The expectations come from equity analysts at large investment banks that study certain stocks. And the number of analysts forecasting annual earnings of a major corporation is typically in the range of 10 to 40. Then there's other research companies that compile all the analyst estimates for a stock and compute the consensus. So it's sort of the average of all the different estimates, analyst estimates. Consensus estimates created by different companies, they vary based on which analyst suggestions they include in their own methodologies. And then analysts base their predictions on trends, macroeconomic data, information in company filings, earnings calls, and anywhere else they can find information. A good analyst might actually go to a store of a stock they're monitoring to gather more information. They do a lot of retail checks. Retail analysts love store checks where they look at just traffic in and out of the store. And it's really more of an art than a science. And then there's something called the whisper number, and this refers to unofficial, unpublished estimates made by professional traders or fund managers on Wall Street, typically in response to late arriving information, inside information, or based on speculation not deemed reliable for a published report. In other words, there's a rumor and there's the whisper number. So the problem here is that, one, analysts are typically sycophants and stenographers, and that is they're paid by an investment bank that wants to play golf with the CEO of that company and get their wealth management and their follow-on equity raised business. That's not to say they're not good at what they do, but they have the wrong incentives. So ideally what you want is a independent analyst. And Arete Research that does telco, my buddy Richard there, they get paid by investors just to give no mercy, no malice analysis. I think Sanford does the same thing. So there's been an emergence of independent equity. I think Lynn Alden is a fantastic analyst, and as far as I can tell, she just calls balls and strikes based on what she thinks. So when you have an analyst from Goldman or Morgan Stanley and a company agrees to take them public, you can bet the analyst is going to come out with a bullish buy report. And then they tend to be very rear view looking. And that is, once the company announces a better quarter, the analyst, takes the price target way up and keeps taking it up until the company throws up on itself and then decides the stock price should have been, or the target price for the stock should have been lower. What you've also seen is a decimation in the bulge bracket analyst community. When I was at Morgan Stanley, the stars were the analysts, because the analysts move the markets, and a company would say, well, if you get Jack, who's the premier telco analyst, Solomon Brothers will give you our investment banking business. And then regulation came along and said, this feels really uncomfortable that you have analysts telling retail investors to buy because they have incentive to get investment banking business. And so they created sort of a Chinese wall, which meant that analysts couldn't have as much direct impact on the profitability of a company because they technically weren't supposed to get or garner or be awarded with investment banking business. So all of a sudden, investment banks started cutting their research staff. So any company with less than $1 billion in market cap generally is undercovered.
Yep.
What I find is really interesting is taking a basic finance course, basic balance sheet, finance valuation. You can take that on YouTube. You can take Damodaran's course, who is literally the dean of valuation, and then reading through the earnings transcript on Seeking Alpha and trying to come up with your own valuation. It's just a really interesting exercise, and it gives you insight into the markets.
Yeah. Just to answer the question in brief, yes, it's a collected average. And we basically take, if we were to say it completely truthfully on this podcast, we'd say something more like a survey from Refinitiv of analysts showed that the earnings per share were expected to be this, but instead, it's an average of pretty trusted, talented analysts on Wall Street. So we just say earnings per share expected were this. But Scott, going back to your question about going back to your point about accuracy, there's this one study that found that on a 3-month time horizon, analyst earnings expectations are only roughly 18% accurate, put another way, just very often wrong. To what extent do you pay attention to analyst estimates and expectations when you're analyzing a stock? Or do you just look at what the company says its forecasts are and also its historical performance?
I read analyst reports to understand the company and get a better feel for the company, but I ignore the price target.
Yep.
I think their earnings estimates are worth looking at. Generally, they do get ranked and evaluated based on their ability or their accuracy around earnings estimates, but I don't look at their price target. I just try and a lot of times have a lot of insight into the company, and you should read both sides, find independent analysts. I mean, some you just want to read everything you can about the company and try and get a real feel for it. I find that there's new sources of information that are really valuable, and that is just doing word clouds on the earnings call and just to get a sense for their strategy. Doing an analysis of Google keyword searches, and that is how many people are searching for Airbnb versus 3 months ago, which will give you a sense for bookings. There's how many people, how many job openings in AI does a company have? Will give you insight into its strategy. It's just there's so many new sources of information. That's not the hard part. People say, well, information is new oil. Not really. Or, okay, if it's oil, it's $1 a barrel. What's really expensive and valuable is refining capability, and that is intelligence that looks at all of this data and these new data sets and says, how does that all bubble up to a buy or a sell recommendation?
Yep. And just a reminder to our listeners, we're reading your questions and comments on YouTube, on Twitter, in our inboxes, so keep them coming and we'll be happy to answer them. Okay, let's take a look at the week ahead. It's a very quiet week for earnings and economic data, but Apple is hosting its Worldwide Developers Conference today and is expected to release its Reality Pro headset. Scott, do you have any predictions?
So it's fun to be provocative. The problem with being provocative is you're usually, or you can be spectacularly wrong. So along the lines of something that might not age well, but I think I feel I have a pretty strong gut around this. I think that Apple's headset is going to be one of the biggest tech failures. I think it's going to rival the Oculus, and it will officially be the most elegant final nail in the coffin of this sort of headset-driven VR consensual hallucination. I think that Apple likely greenlit this project a couple years ago when it looked like VR offered more potential. Everybody thinks that Mark Zuckerberg and Evan Spiegel are smarter than them, and everyone wants to look and feel younger and wants to know what the youngins are thinking. And I bet that Tim Cook said, we hate Mark Zuckerberg. VR offers a lot of potential to go to Greece without going to Greece and perform heart surgery from the Cleveland Clinic on a little girl in a developing country, whatever it might be. And I just don't think it's panning out. And I think if they had it to do over, they would take that $1 billion back they've spent on this thing and not release it. And I'm of the mind that if anyone who knows anything about evolutionary anthropology is that the only thing you will put on your face either protects you from potential predators because it helps you see better, or it raises your cheekbones such that you're more attractive to potential mates. And this will do neither. I think it'll be a gimmick. I think people will try it. And like the Nike Fuel Band, or, oh God, I can't even list all of them that were out there. Remember,
Magic
what were
Leap.
some of the Magic? Oh God, man, remember that Magic Leap?
Yeah.
But all the other wearables and Google Glass, I think it's going to be the most celebrated and most emotional death thrown on the funeral pyre of VR and headsets. So my prediction, the Reality Pro headset is the next segue.
Yeah, I just want to add on to that prediction. I think it's also, I completely agree with you. I think it's also going to seriously harm Apple's brand from an investor relations perspective. Because if you look at the history of Apple products, Apple has basically never launched a product that has failed. They've launched a couple slight failures in the 80s and the 90s. But basically since 2000...
Since you've been alive, bottom line. I mean, you don't remember the Lisa or the Newton or the Cube.
Correct.
They've had some stinkers. Go ahead. Sorry.
But ever since 2000, so that's 20 years, when all of these other tech companies have been releasing a slew of products that have been failures, as you've pointed out, they've had no failures. The only things that have gone slightly wrong have been basically Siri, and Apple Maps had sort of a shaky launch. And the thing that you have praised about Apple in the past, and so has Aswath, is that they've decided to not do a lot of things. Everyone said you should create a car, you should do a TV, you should do a smart fridge. They intentionally chose not to do any of these things. And then what's the one thing that they have landed on after years and years of not creating a new product? It's the fucking headset. So I would add on to that I think that if they launch this thing, Apple stock is going to take an immediate hit in this erosion of the brand and erosion of the trust that they've been building up for so many years.
I like it. We should do a pairs trade.